Two guests joining us now. Both think rates are likely headed lower, but not because of inflation. Joining us to talk all things market, economy, and Fed, let's bring in Brent Schutte, Chief Investment Officer with Northwestern Mutual Management, and Komal Sri-Kumar, President of Sri-Kumar Global Strategy. Brent Schutte, let me start with you. You think the Fed is probably going to stay where it is. You think rates are going to come down next year. It says said in the intro. Why, if it's not lowering inflation?
Because I think you're likely to see a recession. And so to me, inflation is not dead. The Fed is not going to raise early because they don't want to repeat 66 to 82. And I know there was low inflation data this morning, but if you look at the NFIB survey, for example, 34% of small business owners plan to raise prices in the next 3 months. That is the highest level besides the recent period going back into the 1980 time period. You look at compensation plans are still high. The labor market is too tight, which the Fed wants to make sure that wages don't perpetuate inflation and drag it back higher. And I think that means they stick around too long and they keep that liquidity tourniquet on the U.S. economy, which eventually leads to a recession in the beginning half of 2024.
Can we go back to that previous screen that we just had on there for Brent? Because I wanted to get some clarification there on whether you foresee a soft landing or a recession. You see a recession coming, right?
I do see a recession. I see a soft recession. I see one that's not as deep as what people fear. I think it's likely to be soft because the consumer is still in pretty good shape, even after you deteriorate a little bit on the consumer balance sheet. And I also see a Fed that can pivot because inflation will be burned out then. And I think they can pivot and hopefully help kind of cushion the blow as you push into the back half of the year.
Sri, where are you on this sort of soft landing v recession argument?
Tyler, 2 or 3 things. One, I think it is going to be a harder landing than what we just heard. And the reason is that we have had substantial increase in the monetary expansion, as well as zero interest rates being kept for too long a period of time. And from that, when you tighten, you're going to have a pretty serious response from the market. That's the first point. Second, interest rates will come down sharply in 2024, but I don't think it has anything to do with inflation. It has to do with the fact that as the interest rates were increased by 5.5 percentage points over the last 17 months, something is going to break in the system. My top candidates are regional banks. We had the first crisis. I was looking for a credit event for the last year. The first of them happened in March. I think you may have a second or third event also happening within the next 6 months. And that will cause the Fed to cut interest rates as it always had. Even in the month of March, when we had 3 banks failing, recall that the Fed switched over from quantitative tightening to quantitative easing overnight. And if that could do that, if you have a major problem with a medium-sized bank coming up, or if there is a crisis on the commercial real estate area, expect the Fed to react even more strongly, and that's what brings interest rates down. That's what ends quantitative tightening and puts you in the quantitative easing mode. So the reasons causing them are very different from talking about inflation. And the reason, Tyler, is that the last mile, as we keep talking about, is indeed a very difficult one. I have been a student of monetary history for 50 years, and I haven't seen interest in coming down with a soft landing.
Okay. Brent, you're both basically saying that you anticipate recessions next year, maybe one steeper than the other. Brent, it raises the question, are markets prepared for that possible outcome in 2024? As an investor, how do you position yourself for it?
No, I don't think markets are prepared completely for that. I think large cap stocks, for example, have been the hiding place of many investors who now don't believe there's going to be a recession. I think the recession will actually cause some consternation and some declines there. I think the good news is that more economically sensitive parts of the economy, small and mid-cap asset classes, have discounted some sort of recession. That does not mean they won't falter during the recession, but I think longer-term investors should be contemplating positioning more towards those, especially in the event of a recession, because they trade at 12 or 13 times earnings that have already been marked down some. And so that's where I think there's some good news. Plus the reality, I think we both agree that bonds offer value at current yields because we do think that a recession is likely, and that will be the impetus for rates to push lower in the coming quarters.